Well, we're talking about the unemployment rate, 3.9%, the lowest rate since 1974. Imagine that. Lots of people watching won't have been born in 1974, for goodness sakes. You can see all the key numbers there. 13.4 million people now in work, 537,000 unemployed. Underemployment, that's a key one, 6.1%, that's improved. So let's now go here to Bill Evans, who is Westpac's chief economist. In fact, before we do that, let's go to the Prime Minister today, Scott Morrison, talking about these job numbers.
Today is an important day because today, for the first time since 1974, unemployment in this country once again has a 3 in front of it.
So there is the Prime Minister. Obviously, there's a good numbers for the government. So let's now go to the Shadow Treasurer, Jim Chalmers, who also spoke about them.
Even when unemployment is falling in welcome ways, it hasn't generated the real wage growth that we need to see and that we would expect to see. And that's because for the best part of a decade, we've had a government whose deliberate economic policy has been to attack job security and undermine wages. They've fessed that up before.
Well, one of this country's keenest economic watchers is the chief economist at Westpac, Bill Evans, who joins me now. Bill, these numbers, I guess, were coming. I mean, they've been forecast by the Reserve Bank, by Treasury, by just about everybody. They're coming. But I guess today is the day when it finally happened. A 3 in front of the unemployment number, but it's going to get even lower from here, I presume.
Yeah, Ross. Well, it actually happened last month because they revised down last month's number today. So we didn't actually know it was there last month, but it turned out that it was. So today it went sideways at 3.9. And as you say, the lowest number since August 1974. Look, the gap between the unemployment rate and job vacancies is so extraordinary that we can only expect to see further falls in the unemployment rate as we go forward. But it was interesting today that only 4,000 net jobs were created. 92,000 full-time jobs were created, 88,000 part-time jobs. So what was happening was that a lot of people that started the month part-time got more hours to work and therefore qualified as full-timers. And that showed up in a really sharp jump in hours worked, 1.3%. So when you add that really sharp hours worked number to the point you made about the underemployment rate falling from 6.3 to 6.1, you are talking about a very hot labour market, despite the fact that the net jobs growth was only 4,000.
OK, so then take me back to yesterday's number, which was the wage price index, which was subdued, I would imagine, in most people's estimates. Now, at what point do you start to see wage rises? Because, as you know, even in the political debate right now, the argument that inflation is well above the wages growth is a very real thing. Is there a point at which those wages start to catch up?
Look, we saw some evidence in yesterday's number that there's upward pressure on wages. So one of the little looked at numbers, but one that I follow closely, is the wage increase for people that actually had a wage increase in the quarter. And there, on average, that went up by 3.4%. Now, in the December quarter last year, the number was 2.8%. And that 3.4% is the fastest jump that we've seen since 2013. And this will spread. So, for instance, we're now seeing people that are on awards. Unions are asking for 5.5% in the minimum wage. Even some employers are offering 3.7. Last year, it was only 2.5. So it's building, Ross, and I think to look at this slow-moving vehicle that is represented by the wage price index is the wrong way to look at it. Indeed, in the Reserve Bank board minutes, they basically said, look, we used to just look at the wage price index. Now we're taking more notice of our liaison with businesses and the business surveys, which of course are showing much stronger wage pressures.
OK, but if there are wages rising, doesn't that also add to the inflationary story, which therefore puts more pressure on the Reserve Bank to continue to raise interest rates, or indeed to do so more quickly than it might have otherwise anticipated?
Well, Ross, even after that number yesterday, I'm still thinking that the next move will be 40 basis points on the 7th of June. Because for exactly those reasons, the Reserve Bank needs to get ahead of the curve. They need to really convince people that they are serious about containing these inflation pressures. And even to say that we don't have the same problem as we have a much lower problem than the US. If you look at the forecasts They're forecasting inflation to be at 6% by the end of the year, and the US Federal Reserve's only talking about 4.5%. So they're seeing inflation coming back, whereas we've got it still rising. So we need, given that our interest rates are only 0.35 at the moment, we need to make a statement that we're serious about containing these pressures as well, because really next year, without a doubt, wages growth will be much stronger than it is this year. So that'll be pushing up inflation. So the Reserve Bank needs to get to work to contain those interest rate sensitive parts of the economy to bring down those inflation pressures. And that'll mean falling house prices, it'll mean slower consumer spending, and it'll mean a big downturn in housing construction.
Okay, so is that 0.4%, is that enough to change behaviour quickly enough? I mean, it's obviously going to need subsequent rate rises. So at what point do you think interest rates need to get to before consumer and business behaviour changes?
Ross, I think that the first stopping point should be around 1.25%, because if we look at our debt servicing ratio analysis, so the proportion of your income required to service your mortgage, at 1.25%, you're getting back to the sort of levels that we've seen in previous cycles. So that'll be the first stopping off point, but I don't think they should be stopping for too soon, because the household sector's got a lot of cover this time. They've got buffer of that $240 billion of savings that have been accumulated during COVID. So they'll be more resistant to rate hikes this time than they have been in previous cycles. And I think the Reserve Bank will find that they need to go above that 2% level next year in order to achieve those objectives of taking the heat out of demand to contain these inflation pressures. They've set themselves a goal of reducing underlying inflation from 4.75% to 3.25% next year. That's a big challenge.
Tell you what, Bill Evans, always good to have him in the program. Many thanks for your time today.